So the state of California is essentially causing a crisis with their homeowners insurance and a little bit on their auto insurance as well. Some of the rules and regulations that they've put into place have caused some havoc. And let's dive in a little bit deeper. There's 5 essential pieces that the state of California has caused or created this environment to where companies like State Farm and Allstate and the restrictions of farmers insurance policies are no longer writing homeowners insurance. We also want to dive a little bit further in to explain how that's going to affect the market. And stay tuned because near the end of the video, we're going to go over some of the rate increases that are currently filed with the state. So what you can expect and what companies are following suit with the State Farm homeowners crisis. Let's dive into the number one reason why the crisis is happening in California. I spent several hours researching what is actually causing this. And there are some major pieces that California is explaining that their laws are causing problems for insurance companies. Let me know in the comments below as we go through these if you think that they're helpful or if they are causing these companies to disappear. The biggest thing, and one of the pieces I think is one of the larger issues, is that when insurance companies factor their rates, they're not allowed to factor in reinsurance. If you watched our previous State Farm video where we talked about the crisis, we'll link it at the end, where State Farm officially has left the state as far as pausing their home insurance policies. Their biggest reason is wildfires. To give you a quick summary, it wasn't just wildfires, it was the cost of repairing or insuring, and a lot of that had to do with reinsurance costs have gone up. They're roughly 17 to 20% higher for a State Farm company. The issue is the state won't allow them to calculate that in their price model. So even though they're getting a 17 to 20% rate increase, they're not allowed to turn around and charge the people of the state. Now that's all fine and dandy, and I get it. As a consumer, I wouldn't want to pay that either. However, if you go to California's website and you read some of their talks about these pieces, they're very proud on how they stop farmers from having a large increase. I took this straight off their website. They said here, California law requires insurance companies to get approval for rate hikes from the state. We'll explain that in a moment. Copied straight from their website, it says Farmers was denied a $72 million and brought down to a $34 million rate increase. That saved about 1.2 million homeowners an average of $28 per year. So they saved themselves about $28 per person. It sounds like a huge number, but California is so large that that $28 rate increase could have made the difference between you allowing State Farm or farmers or these other companies to open those products, or did it cause them to have to shut the doors? Because yes, State Farm or farmers in this case would have made a lot more money, but now because of those pieces, they can't recoup the money that they needed to survive or be profitable in that state, which essentially decides we just can't write the business now. So is it worth the proudness of saving the money versus paying the extra $28 on the homeowner's insurance just to keep the companies in the state? And that leads into the second reason the state's laws are causing these insurance companies to essentially go semi-insolvent or at least pause their business. There's something called the Proposition 103, and that's essentially a regulation that insurance companies can't raise their rate beyond a certain amount. So you may notice if you're a California resident, your rate usually only goes up by 6.9%. That's not because the insurance companies are following inflation. They're actually below and not keeping up with it. And the reason they do that is if they file above a 6.9, I think it's actually 7%, but if they go above that, they have to go to court to show the reasoning behind this. Now, I researched that a little bit further and said, well, why is that a big deal? They're used to going to court. Well, the thing is, in order to go in front of a judge, it takes up to 8 months for them to get that hearing. So 1, their rate hasn't been approved, and 2, it goes 8 months out before they can even get seen, and then 3, if they do get seen and denied, they have another 2 months before they can refile it. And then they're stuck with that 6 point some odd percent, or if they've come to some sort of agreement, they get lower than what they requested. I'm trying not to put my personal opinions on these, but that is weird. Before we dive into the third piece, I'm going to go over some of those rate changes that we're talking about because we are talking about rate increases at this point. And I wanted to let you know that if you guys are seeing a large rate increase, because there are a few companies that actually got approved beyond the 6.9%. Some of them snuck in and got a 15 to 20% rate increase. And another company here we're going to mention is actually filing over a 40% rate increase. Actually, I think it was approved, so we'll go over it here in just a moment. If you are shopping for car or home insurance, I'll put a link in the description below. I'm actually connecting with some companies that are able to help you guys out to shop it around with different agents. that's available to you. Otherwise, let's dive into the main rate increases that I found, and I just went over the more recent ones. So as of April 27th, Root Insurance was a big company known in the state. Well, they just filed for an auto liability and a physical damage, that's car insurance essentially, to have a 62.4% increase. That essentially says that their model isn't working in the state as well as they hoped. The next one is called Independent American Insurance, and they're filing a 27 plus rate increase as well. Now, these ones I believe are already approved, so these are the rates that you're going to see coming up pretty quickly if you haven't already seen them change. 21st Century, Travelers, Amica, and Geico, they have also filed a 6.9% rate increase, which is pretty much a guarantee that they are or will be approved. Expect those rates to start to change. Wawanesa is a major company in the state, and they've filed and been approved for a 15% rate increase as well. Now, keep in mind, some of these rate increases don't necessarily mean that the whole policy is going up by that much. Kind of normally it does, but they usually do pieces. So when you look at like a car insurance policy or a home policy, they have different sections like coverage A, B, C, D. And I've got a video on this channel that goes into depth on what those are, but usually they have to show proof of why that's going up. So we had X amount of losses, this happened, that happened, here's why we want to go up, and here's the rate we want it to be. Well, most of them are going the 6.9% as you saw, and that's those sections, the property, the physical damage of a car, or the liability portion, which is honestly the biggest piece of an insurance policy. Farmers actually did file a rate increase. They wanted 24.9%. They have about a 17.7% increase according to the state of California's website. And like I said, this is actually causing a little bit of a ripple. So you're starting to see some of these companies say, you know what, it doesn't matter. We can't make money. Either we pause the insurance or we go to court. We have to wait the 8 months, go through the process. If we get denied, we're done. We're going to pause the insurance. I actually watched an interview of the governor that explained that this was lawful, because that's one of the concerns and questions that people are asking. How can you just let them pause insurance? Well, the type of business and doing business in the state is not required by law. The rates can be regulated, but the business cannot. The third reason or way that the government in California, their rules and regulation is causing home insurances and regular insurances in general to have issues is there's something called the efficient proximity clause. So this is really easy to understand. It's very confusing if you read it, and I had to spend an hour figuring it out. So the easiest way to think of this is when we take the wildfires into consideration, because that's the biggest claim. There's actually a good story I'll tell you here in just a moment. But if a wildfire were to cause another concern, essentially your home policy doesn't cover earth movement, doesn't cover flood. There's separate policies for that. It doesn't cover certain scenarios. And if the cause was because of something else, essentially i.e. a wildfire, it caused the earth to shift or a flood to happen, a dam broke, whatever the case was, and water damaged the house that wasn't normally covered, well, the government forces you to have to be covered on that scenario. I actually kind of agree with that one, to be honest with you, but it tightens up because the insurance companies can't rate the risk for that scenario. So they're not allowed to take those numbers and calculate them the way that they need to, and to expect to successfully raise the rates based on that scenario. Now, I didn't dive in, and I probably won't go super far into. There are a couple things that the laws got a little confusing where they don't necessarily allow, and they say they're going to allow, the technology to improve. So what I mean by that is they're only allowing insurance companies to use the data from the past. They're not allowing insurance companies to use what's called a predictive model. They can take all the data and it can predict what the future claims are going to be based on the weather and all of the economic climate and all of that shift. And so they can determine, hey, we need to go another 2% up or down or whatever the case is because this predictive model is accurate and it says this. Well, they are starting to allow that, but right now they haven't, and they currently don't that I'm aware of. So let's dive in. I actually got a really good story that explained this. It was actually a case. So it was the case of Howell versus State Farm Fire and Casualty Company. So essentially what happened was the property owner made a claim for landslide damage to her property. So land shifted, damaged her property following heavy rains. The insurance company denied the claim because the policy excluded coverage for earth movement and for water damage. The property owner presented expert testimonial that the landslide occurred due to a fire which destroyed the vegetation on the slope the summer before the landslide. The Court of Appeal concluded that an insurance company providing coverage under a property insurance policy may not contractually exclude coverage when an insured peril meaning the occurrence, such as a fire, is the efficient proximate exclusion for damage caused by mudslide was not enforceable. Regardless of other contributing causes, the court found that because fire was the efficient proximate cause, so we're just talking about, the cause of the mudslide, the policy exclusion of the damage caused by the mudslide was not enforceable. And they essentially won that claim. In that scenario, that's essentially one of the pressures that insurance companies have. The fourth, actually /fifth, because I think the rates were supposed to be my fifth one, but I decided to put it in early. The fourth one is the FAIR. It's the FAIR Act that the state has provided. The FAIR Act is actually something that's good in the state because what it does is allows those that can't afford the insurance, or if the rates are too crazy, if they're in a high risk zone, I think they have up to like $3 million that they can get coverage for. Now, if you go to their website, you should read through it very carefully because they're very strict and say this is not a good policy. It doesn't cover as much as a typical policy would have. I'm assuming it's missing the liability pieces and essentially just covers the home for the main parts. You'll have to dive in further if you want to get into the actual policy of it, but that's a warning from them themselves. They strictly say this is like a last resort for somebody. What that does is some people don't see it as a last resort. And so it's almost like companies are losing a little bit of business. I don't think it's as big of an impact, but they're losing a little bit of business to that scenario because it is cheaper to go with something like that in a lot of different cases. And if the government's going to pay for part of the bill or pay for part of it in that scenario, then why wouldn't you? Clearly, it's not the same coverage. Do your research on that part. But that is causing a little bit of competition amongst the companies that can't already raise the rates to be competitive to where they need to be. Do you think any of these rules or laws or guidelines should be adjusted? The normal one that I hear all the time is the rate increase cap. Right? It's not legally or technically capped, but the force of having to go through these steps and these pieces are part of it. Things I didn't dive super heavy into, which you may want to learn more about or do some research on, is that they do also have something called a duty of faith, good faith. And that one honestly was kind of like most places have it. It's like what you can and can't do, when you can deny it, how quickly you have to file a claim. And the dates that they give are a little bit stricter. So companies in California have to react a little bit faster than I'm used to seeing. And I didn't see a ton there that honestly made a big impact as far as I saw. But from my research, that is, once again, the fifth, I guess you could call it, piece that the state is tightening up to where that good faith piece forces the insurance companies to be a little bit tighter on how quick they respond and whatnot. Let me know what your thoughts are in the comments below. I'm Mark with Think Insurance. I'll see you in the next one.